What if the smartest move in the stock market is to stop trying to be smart at all? What if the way to beat most investors is simply to own the entire market, keep your costs tiny, and then do nothing? Stay with me, because over the next few minutes you might realize that common sense can beat Wall Street at its own game. Welcome to this audiobook-style summary of The Little Book of Common Sense Investing by John C. Bogle, the founder of Vanguard and the father of the index fund. This is a book about money, yes, but more than that, it is a book about sanity, about stepping out of the noise, the hype, and the chaos of the market, and choosing a simple, patient path that gives you your fair share of American business. So imagine this. Two neighbors live side by side in a quiet American suburb. One is constantly checking stock quotes on his phone. He jumps in and out of hot funds, follows every headline, and brags about beating the market. The other neighbor? She buys a low-cost index fund that owns the entire stock market. She adds a little money every month. She rarely looks at the news. She rarely looks at her account. Fast forward 20 or 30 years. Who wins? Bogle's message is clear. Overwhelmingly, it is the quiet neighbor. The one who trusted the market as a whole, kept costs low, and stayed the course. This is the core of common sense investing. Let's walk through the big ideas, step by step, and turn them into a simple plan you can actually use in your real life. First, we need to answer a basic question. What does it mean to invest? Bogle draws a sharp line between investing and speculating. Investing means you own businesses. You share in their profits, their growth, their dividends. When the U.S. economy grows, your share of ownership grows with it. Speculating is something else. Speculating is trading pieces of paper back and forth, hoping that someone will pay more tomorrow than you paid today. Your attention is on the price, not on the business. Most of what you see on financial TV, online, on social media, is speculation dressed up as investing. Predictions, hot stock picks, market timing, swing trades, it all sounds smart. It all feels exciting. But Bogle wants you to step away from that casino. He reminds us of a brutal truth. In the short run, stock prices are a voting machine. People vote with their emotions, their fear, their greed. In the long run, the market is a weighing machine. It weighs the real earnings, the real cash flows, the real value of businesses. Common sense investing is about the weighing machine, not the voting machine. Here's the next big idea. Before costs, investors as a group earn the market's return. After costs, they earn the market's return, minus fees, minus taxes, minus trading expenses. This is what Bogle calls the relentless rules of humble arithmetic. Picture the entire U.S. stock market as a big pie. All investors, together, own that pie. Before you subtract any costs, the group as a whole earns the full growth of that pie, the total return of all those businesses combined. Now, add Wall Street in the middle. Trading costs, management fees, sales commissions, marketing budgets, consultants, layers and layers of people taking a slice of your slice. Every extra fee, every unnecessary trade, every fancy product takes a bite out of your pie. So if the whole pie grows at, say, 7% a year over the long run, but you pay 2 or 3% a year in total costs, you are quietly giving away almost half of your real return. It does not happen in 1 year. It happens silently, slowly, over decades. 2% might not sound like much, but when compounding works against you instead of for you, the final numbers are shocking. Imagine two investors start with the same amount of money. One uses a low-cost index fund at, say, 0.05% a year. The other pays around 2% a year in combined costs, fund fees, advisor fees, trading costs. Over 30 or 40 years, even if they both earn the same gross market return before costs, the low-cost investor ends up with dramatically more money. often hundreds of thousands of dollars more on the same starting investment. Bogle's point is simple and devastating. In the long run, costs matter far more than cleverness. So how do you keep costs low and still get your fair share of the market's return? Here comes Bogle's favorite solution: the broad, low-cost index fund. Instead of trying to pick winning stocks, an index fund buys them all. Instead of trying to find the needle in the haystack, you just buy the entire haystack. A total stock market index fund, or an S&P 500 index fund, simply owns a slice of virtually every major American company. No constant trading, no star managers, no predictions, just automatic mechanical ownership of the market itself. Why is that so powerful? Because when you own the market, by definition, you get the market's return. Not more, not less, before costs. And when your costs are almost zero, you keep almost all of that return. Meanwhile, active managers are beating each other up inside the same arena. Think about it this way. For every investor who outperforms the market, there must be another who underperforms by an equal amount. That is the zero-sum game before costs. Now, overlay fees and trading expenses. Once you subtract those costs, the average active dollar must underperform the market's return. So, as a group, active investors cannot win. They must, on average, lose to the market they are trying to beat. And because index fund investors simply own the market at extremely low cost, they are quietly positioned to outperform the majority of professionals over the long run. That is the paradox at the heart of Bogle's message. To outperform most investors, you must stop trying to outperform. You must be average in strategy and excellent in discipline. But if the math is so clear, why are so many people still chasing hot funds and hot stocks? Bogle gives a few reasons. First, there is the powerful lure of stories. We love stories of genius managers who called the crash or picked the next Amazon. These stories sell magazines. They generate clicks. They attract assets. What you rarely see are the thousands of managers who tried and failed, or the same manager's full track record, including the years they underperformed. Second, there is survivorship bias. Funds that perform poorly are often merged, closed, or quietly buried. The survivors look impressive because the losers are no longer in the data set. Third, there is performance chasing. Investors pour money into funds after a great run and then bail out after a bad stretch. In other words, they buy high and sell low. Instead of capturing the fund's long-term return, the average investor captures a much lower return because their timing is driven by emotion. Bogle wants you to step out of this emotional cycle. Forget about the short-term scoreboard. Forget about top-performing funds and five-star ratings. Instead, commit to a simple, rules-based strategy that you can stick with for decades. Now let's talk about time. Because in Bogle's world, time is your greatest ally. The U.S. economy is not a straight line. There are booms and recessions, bull markets and bear markets, euphoric bubbles and painful crashes. But zoom out far enough, and a pattern emerges. Over long stretches, broad-based ownership of American business has delivered solid real returns above inflation. When you own a low-cost index fund and hold it for decades, you are not betting on one CEO, one sector, or one hot theme. You are betting on human ingenuity, productivity, and the long-term growth of the economy. Time allows compounding to work its quiet magic. Dividends are reinvested, earnings grow, companies innovate, merge, and evolve. Short-term price swings start to look like noise, and the long-term trend begins to dominate. But there is a catch. For time to be your friend, impulse must not be your master. You have to resist the urge to panic in downturns. You have to resist the temptation to chase fads in euphoric times. Bogle's advice is blunt. Your success as an investor will not be determined by how clever you are. It will be determined by how disciplined you are. Can you stay the course when the headlines scream panic? Can you keep buying when markets are down and everyone around you is scared? Can you ignore the urge to jump ship when your portfolio temporarily shrinks? If you can, the odds tilt sharply in your favor. Now, let's bring this down to a practical level. How does common sense investing look for a normal American saver? Picture someone with a 401k at work, maybe an IRA on the side, maybe a small taxable brokerage account. Instead of picking 10 different hot funds, chasing last year's winners, they could build a simple, diversified portfolio around 2 or 3 core pieces. One broad U.S. stock market index fund, maybe one international stock index fund, and one broad bond market index fund. That is it. No endless complexity, no constant tinkering, no obsession with sector rotation or tactical shifts. The exact mix between stocks and bonds depends on your age, your risk tolerance, and your goals. Younger investor? You might lean heavier on stocks because you have time to ride out volatility. Closer to retirement? You might add more bonds for stability so you can sleep at night when markets get rough. Bogle does not pretend there is one perfect allocation for everyone. What he insists on is this: whatever allocation you choose, stick with it. Rebalance occasionally. Keep costs low. Let the plan work. You will never have the sexiest strategy at the dinner table. You will not impress anyone with stories of doubling your money in 3 months. But 10, 20, 30 years from now, the slow, boring, disciplined strategy is very often the one that quietly wins. Of course, at this point, a natural question comes up. If it is all so simple, why is the financial industry so complicated? Bogle does not shy away from this. He argues that Wall Street has a built-in incentive to make things look complex, sophisticated, and mysterious. Complexity justifies higher fees. Mystery justifies sales pitches. The idea that you need constant trading, specialized products, or expensive expertise keeps the industry wealthy, even if it does not keep you wealthy. When you choose a low-cost index fund and a stay-the-course approach, you are, in a sense, firing a large portion of Wall Street from your life. You are saying, I do not need you to pick stocks for me. I do not need your predictions. I just need a simple, low-cost way to own the market. This is not what the industry wants to hear, but it is what your future self wants to hear. Now let's dive into some of Bogle's core principles, his rules for common sense investing, and translate them into everyday language. First principle. Remember reversion to the mean. In plain English, that means what outperforms like crazy in the short run often falls back to earth. What lags badly for a time can catch up later. So when you see a fund with amazing recent performance, resist the urge to assume that trend will continue. The market has a way of humbling the hottest stars. Second principle. Time is your friend. Impulse is your enemy. This is a call to think in decades, not days. If you treat your portfolio like a trading account, you invite your emotions to drive the car. Fear and greed will constantly push you toward bad decisions. If you treat your portfolio like a long-term ownership stake in the economy, you give time and compounding a chance to work. Third principle. Buy right and hold tight. Buying right means choosing a broad, low-cost index fund that truly represents the market, not a narrow, gimmicky product that concentrates your risk. Holding tight means resisting the urge to jump in and out based on headlines, predictions, or your neighbor's enthusiastic tips. Fourth principle. Have realistic expectations. You are not entitled to double-digit returns every year. Markets move in cycles. There will be years of outstanding returns and years that test your patience. Bogle encourages investors to understand that long-term returns come from business fundamentals, earnings growth, dividends, and starting valuations. Fifth principle. Forget the needle. Buy the haystack. Trying to find the next big winner is seductive but extremely difficult. Instead of gambling your future on a few guesses, spread your risk across thousands of companies by owning the entire haystack through an index fund. Sixth principle, minimize costs relentlessly. Look at every fee you pay, fund expense ratios, advisor fees or trading commissions, hidden transaction costs. Ask yourself, is this fee truly earning its keep, or is it just quietly draining my future wealth? Often you will find that paying an extra 1% a year sounds harmless, but over a lifetime, it is like surrendering years of retirement income. Seventh principle, there is no way to escape risk entirely. If you stay all in cash, you face the risk of inflation silently eating your purchasing power. If you invest in stocks, you face the risk of volatility and temporary declines. The goal is not to avoid risk. It is to choose the right kind of risk, the risk that gives you a fair chance at reaching your goals. Eighth principle, do not fight the last war. Investors often base their decisions on what just happened. After a crash, they fear stocks forever. After a boom, they assume the good times will never end. Bogle reminds us that the future will not look exactly like the recent past. Chasing yesterday's pattern is a dangerous way to invest. Ninth principle, the future is uncertain, always. No one knows exactly what the market will do next year or even the next 5 years. There will always be experts predicting both boom and doom. Because the future is uncertain, the smartest thing you can do is build a robust, low-cost, diversified strategy that can survive many different scenarios. And then stick with it. 10th principle, stay the course. This is Bogle's favorite line. Stay the course when markets fall. Stay the course when markets soar. Stay the course when pundits scream that this time is different. If your strategy is sound, your discipline is more important than your ability to predict. Let's take a moment and imagine how this might feel in real life. There will be years when your index fund drops 20%, maybe more. Headlines will talk about crisis, recession, fear. Friends and coworkers will debate selling everything. In those moments, staying the course will not feel easy. It will feel almost unnatural. But if you look back at history, those who consistently panicked and sold at the bottom locked in their losses. Those who stayed in the market or even increased their contributions during downturns were often rewarded when recovery came. On the flip side, there will be euphoric years when the market is soaring. People will boast about speculative bets that tripled. New assets and new trends will seem unstoppable. In those moments, staying the course means not abandoning your simple plan for a shiny new gamble. It means remembering that trees do not grow to the sky, and that discipline matters more than excitement. Bogle's philosophy is not about getting rich fast. It is about getting rich slowly, predictably, and with as little drama as possible. He believed that common stock investing should be an act of faith in the future of human progress. When you buy and hold a broad index fund, you are expressing confidence that companies will continue to create value, that people will continue to innovate, and that economies will continue to grow over the long term. You are also accepting that along the way there will be shocks, crises, and periods of disappointment. But instead of trying to dance in and out, you plant your feet and let time do its work. This is common sense investing. Not flashy, not glamorous, but deeply powerful. Now, as we begin to wrap up this summary, let's bring it back to you. Maybe you are just starting out, putting your first few $100s into an investment account. Maybe you are in midlife, with a 401k that feels messy, and maybe you are approaching retirement and wondering if you are really prepared. Wherever you are, Bogle's advice can be boiled down to a few simple actions. Own a broad slice of the market through low-cost index funds. Keep your costs as close to zero as you can. Choose an asset allocation you can live with in both good times and bad. Add money regularly through thick and thin. Resist the urge to trade based on fear or hype. And above all, stay the course. It will not make you the center of attention at a party. But one day, when you look at your accounts and see the quiet power of decades of compounding, You might be very glad you chose boring over exciting, discipline over drama, and common sense over speculation. Let's close with the spirit of John Bogle himself. He spent his career arguing that the financial system should serve investors, not the other way around. He believed that ordinary people deserved a fair shake, a way to participate in the growth of the economy without being drained by unnecessary costs and complexity. Every time you choose an index fund over a high-fee product, you are voting for that vision. Every time you ignore the noise and keep investing through the ups and downs, you are living that philosophy. So, as you step away from this summary, here is your challenge. Look at your current investments with fresh eyes. Where are you paying too much in fees? Where are you complicating things that could be simple? Where are you chasing stories instead of trusting the math? And then, decide what common sense investing will look like in your life. If this audiobook-style summary helped make Bogle's ideas clearer, I would love to hear from you. Which principle hit you the hardest? Was it, time is your friend, impulse is your enemy? Forget the needle, buy the haystack? Or the simple but powerful command to stay the course? Share your thoughts in the comments. Tell us what changes you are going to make in your own investing strategy after listening to this. And if you want more long-form, calm, no-hype summaries of the greatest investing and business books ever written, make sure you subscribe, hit the like button, and share this with someone who is still trapped in the noise of Wall Street. Remember, you do not need to be a genius to be a successful investor. You just need a plan, a low-cost index fund, and the courage to stick with common sense when everyone else is chasing the next big thing. Thank you for listening to this summary of The Little Book of Common Sense Investing by John C. Bogle. Stay disciplined, stay patient, stay the course.